$5 trillion. That is the scale of agreements that can sit outstanding in the U.S. repurchase agreement market, the quiet funding lane that keeps the financial system moving. Most people never see it. Yet when that lane narrows, the reaction is not slow. In one past episode, overnight funding rates didn't drift. They spiked from around 2% to nearly 10% in a single burst. Not months, not weeks, in hours. And the lesson was brutal. The system can look fine on the surface right up until it doesn't. Now here's the part that breaks normal expectations. A widely watched set of broad financial condition readings can still look easy, even as stress begins to concentrate in the places that matter most. That contradiction is the reason you're hearing more whispers about stress indicators hitting critical levels. It isn't that every dashboard is screaming at once. It's that the wrong dashboards are calm while the right ones are tightening. What I'm about to lay out is not a mood or fear or a vibe. It's a pattern. It's about how funding stress shows up before it becomes a headline, how institutions react before the public language changes, and how a small crack in short-term financing can widen into a market-wide dislocation. Welcome to North Star Macro, where we decode what matters before it becomes tomorrow's narrative. If you've ever felt like the news arrives after the real move has already happened, that's because it often does. Consider this your seat in the room where the plumbing gets watched. And if you're listening like that wise elder who always wants the full picture, you already know what to do with the channel. Drop a comment with where you're watching from, because the signals we're talking about don't stay in one country or one asset class. Here's what happened, and why the timing matters. In early February 2026, headline conditions still looked surprisingly relaxed in at least one broad index of U.S. financial conditions, the kind of number that, on paper, suggests credit is available and stress is below average. At the same time, other stress proxies that traders actually feel began to flare. Volatility in areas that usually stay sleepy started to swing. And the reason this matters is that market stress rarely announces itself with a single siren. It spreads through contradictions. You can think of the financial system as a city. The stock market is the skyline. It's what people photograph. The credit markets are the highways. The repo market is the water system. If water pressure drops, the skyline still looks pretty for a while. Lights still glow. But the moment enough buildings try to draw water at once, you find out whether the pressure is real or imagined. Repo is simple in concept. One party lends cash, the other party delivers securities as collateral, with an agreement to buy them back later at a slightly higher price. That tiny difference is the interest rate. It's a way for banks, dealers, and funds to finance holdings, to smooth settlement, to stay liquid. The key word is collateral. Repo is only as stable as the trust in the collateral and the confidence that cash will be there tomorrow morning. When stress indicators hit critical, it often means one thing. The market is starting to question that confidence, not in speeches, in prices, in haircuts, and who is willing to lend to whom and at what terms. And that's where the first contradiction appears. Broad indexes can say conditions are easy because they average across many markets. But plumbing stress is not an average. It's a bottleneck. And bottlenecks are nonlinear. Nothing happens until everything happens. To understand why this matters, you have to look at the historical pattern because the playbook repeats. In 2007, stress did not begin with a stock crash. It began with funding doubt. A few corners of securitized credit started to wobble. Then repo terms tightened for certain collateral. Then institutions that relied on rolling short-term funding discovered they could not roll it at the same price, or at all. The skyline looked fine until it didn't. Result? A cascade of forced selling, a collapse in confidence, and eventually an emergency. Re-engineering of the entire financial system. In 2019, the pattern became impossible to ignore for anyone watching the plumbing. Overnight repo rates surged dramatically, a sudden scarcity of cash against high-quality collateral. It wasn't a credit crisis in the usual sense. It was a distribution problem. Cash and reserves were not where they needed to be at the moment they were needed. Result? Emergency operations to calm funding, a reminder that even in calm markets the plumbing can jam, and a renewed awareness that the system is built on rollover risk. Now in 2026, the same pressure points are flashing again, even if the surface picture is mixed. And concentrated stress is what breaks systems. So who moves first when this happens? Institutions. Not because they're smarter, but because their survival depends on not being last. When funding becomes fragile, the first visible actions are not dramatic press releases. They are subtle shifts, shortening the maturity of funding, increasing the quality of collateral held, widening the margin of safety in internal models, and changing the way they price risk to counterparties. You see it in the fine print of clearinghouse updates. You see it in how dealers quote liquidity. You see it in where cash prefers to hide. And this is where it gets interesting. The institutions that look calm in public can still be acting defensively in private. That is not hypocrisy. That is how risk is managed. Public calm preserves confidence. Private caution preserves solvency. Look at the mechanics that can turn a small stress signal into a system-wide event. Imagine a dealer financing a portfolio of bonds overnight. Every morning, that dealer has to renew or roll that funding. If the repo rate rises, the cost rises. If the haircut rises, the dealer must post more collateral for the same cash. If the counterparty shrinks the amount of cash it will lend, the dealer must find another lender. In a calm market, this is routine. In a stressed market, it becomes a daily scramble. Now stack that across hundreds of institutions. Add one more ingredient: timing. Funding stress often spikes around settlement dates, tax payments, large treasury issuance, or moments when balances shift. It doesn't need a villain, it needs a mismatch. When cash demand rises, at the same time cash supply is constrained, rates jump. When rates jump, leveraged positions become harder to carry. When positions become hard to carry, assets get sold. When assets get sold, prices fall. When prices fall, margin calls rise. When margin calls rise, more assets get sold. The plumbing becomes the engine. This is the mechanism behind critical level stress. It's not one number, it's a feedback loop, and loops don't announce themselves politely. The most important part is the dislocation, because that is what signals instability. Two markets can tell opposite stories at the same time. One can be calm, the other can be strained. For example, equities can be levitating on optimism while funding spreads quietly widen. Credit indices can be stable while repo terms for certain collateral worsen. Official measures can say conditions are easy while volatility in hedging instruments rises. When those contradictions grow, something has to resolve. Think about paper versus reality. Paper says liquidity is abundant if broad indexes are loose and headline borrowing costs are manageable. Reality says liquidity is scarce if the institutions that intermediate liquidity are pulling back, demanding more collateral, or pricing uncertainty into short-term funding. Paper can stay calm until reality forces it to adjust. So let's talk evidence with numbers, because that keeps us honest. The repo market is not a sideshow. $5 trillion. That is not a niche. That is the central pipe. And research simulations have shown that disruptions at a small number of critical institutions could affect more than $100 billion in funding and move repo rates by more than 50 basis points. In a market where a few basis points matter, 50 is a shock. Then remember the historical spike, a move from around 2% to nearly 10%. That is the kind of jump that turns fine into panic for any strategy that depends on cheap, stable overnight financing. It's also the kind of move that reveals a deeper truth. Even high-quality collateral does not guarantee smooth funding if the distribution of cash is impaired. Now add the second layer, volatility. When volatility rises in markets that are usually calm, it's a sign that hedging demand is increasing. It often means large players are paying up to protect themselves, or dealers are less willing to warehouse risk. That is not always visible in stock indices. It's visible in the price of insurance. And that leads to the central mystery. How can broad financial conditions look loose while the plumbing begins to tighten? Because averages hide tails, because financial stress is not evenly spread. It appears first at the edges, where leverage is highest and funding is shortest, and the edges connect to the center through forced selling, and it didn't take months to spot the shift. That kind of pivot usually doesn't happen because someone read a gloomy headline. It happens because someone saw a price that shouldn't exist. One reason stress can hide is that many widely quoted indicators are built from averages of credit spreads, equity volatility, and lending conditions. They are useful, but they are also lagging in a very specific way. They respond after the distribution of liquidity has already changed. If a broad index prints a benign figure, like a negative reading that implies easier than average conditions, it can lull observers into thinking nothing is wrong. But the market doesn't break at the average. It breaks at the margin. The margin is where the short-term borrowers live. Dealers financing inventories, funds rolling leverage, arbitrage desks running trades that only work if financing stays stable. Those strategies can look low risk when everything is smooth because price differences are small, but the leverage is large and the financing is short. A perfect example is the treasury basis trade, where a fund buys a treasury bond and sells a treasury futures contract against it, harvesting a small spread. It sounds boring, that's the point. The spread is small, so the leverage is often large. The position is carried through repo. If repo costs rise or haircuts increase, the economics change. If the futures bond relationship moves, margin calls arrive. If margin calls arrive at the same time financing tightens, positions get unwound. And because the trade can be enormous in size, unwinds can become market events. That's why critical stress is not a dramatic phrase. It's a technical description of a system operating close to its limits. And when you're far from the limit, a bump is a bump. When you're near the limit, the same bump becomes a crash. Now look at the institutional layer, because this is where positioning becomes visible if you know what to look for. Large dealers and banks manage intraday liquidity, regulatory ratios, and collateral allocations with extreme precision. When conditions are calm, they can intermediate smoothly. When conditions tighten, they ration balance sheet. That means they become more selective about repo counterparties, more demanding about collateral quality, and less willing to hold inventory that requires financing. At the same time, money market funds, which are massive providers of short-term cash, make choices based on safety and yield. When uncertainty rises, they can shift preference toward the safest structures and away from exposures that feel even slightly ambiguous. That shift can be subtle at first, but in a market built on rolling short-term agreements, subtle shifts accumulate quickly. Then there are clearinghouses and exchanges. When volatility rises, margin models respond. If a clearinghouse raises margin requirements, it demands more cash or collateral from participants. That is not a moral judgment. It's a risk control mechanism, but it has a predictable effect. It pulls liquidity out of the system at the exact moment liquidity is already becoming scarce. It forces selling in some places and hoarding in others. It turns price moves into liquidity moves. This is where it gets interesting because the timing of these changes can look like coordination, even when it's just common incentives. Institutions read the same prices. They run similar stress tests. They fear the same feedback loops. So they act in the same direction at the same time. Not because they have a secret meeting, but because survival produces herding. And remember the simulation point. Disruptions at a few key institutions can affect more than $100 billion of funding and push rates noticeably higher. You don't need every firm to be stressed. You need the wrong node to be stressed. The system is a network. The most connected nodes matter more than the average node. So let's talk about the dislocation in a way that you can feel. On one side, you have a calm-looking broad condition index. On the other, you have the kind of volatility and hedging demand that suggests unease. Add the funding layer. If short-term financing gets even slightly more expensive or less available, leverage strategies start to deleverage. That deleveraging can show up as selling pressure in assets that have nothing to do with the original stress point. That's why markets can look irrational in these periods, because the news is not the driver. The margin call is. The funding term changes, the collateral haircut is, and those forces don't care about narratives. Another contradiction appears between official liquidity and usable liquidity. Reserves in the banking system can be ample in aggregate, but if they are trapped in places that can't deploy them quickly, the effective liquidity can still be scarce. The system then relies more on a small number of intermediaries, which increases fragility. It's like having plenty of water in a reservoir, but broken pumps in the neighborhood where the fire is. Now compress the timeline. When the pipes tighten, it can happen inside 48 hours. A repo rate moves, a margin call hits, a fund sells, prices move, volatility rises, the next margin cycle demands more collateral, more assets are sold. The reaction is built into the structure. There's also an institutional signature. Policy language changes after the plumbing forces it. The operations can be quiet, but the intent is clear. Restore confidence in funding. And that brings us back to the core claim. When a stress indicator hits critical, the most dangerous moment is not when everyone is scared. It's when most people still think the system is calm, because the average gauges say so. That's when liquidity is most likely to be mispriced. Let me show you the logic bridge that ties this together. The repo market is huge. A small change in rates or haircuts affects leveraged balance sheets. Leveraged balance sheets are common in strategies that look low risk in calm conditions. When financing tightens, those strategies unwind. Unwinds create selling pressure in large liquid markets. Selling pressure widens, spreads, and raises volatility. Higher volatility triggers higher margins. Higher margins demand more cash. More cash demand tightens funding further. That loop is the hidden engine behind sudden market dislocations. The data suggests the edge is closer than the calmest indicators imply, and the plumbing signals are the early warning. When the system resolves a dislocation, it usually resolves in one of two directions. Either funding normalizes and the scary signals fade without major damage, or funding stays strained and the scary signals migrate upward into broader markets. That migration is what turns a niche discussion into a mainstream story. If you want one final way to think about it, think of stress as heat. Heat doesn't instantly melt the whole machine. It concentrates at the friction points, bearings, joints, places where movement matters. The repo market is a bearing. Clearing margins are a joint. Dealer balance sheet is a friction point. When those heat up, you can still have a beautiful skyline for a while, but the machine is telling you where it's vulnerable for anyone paying attention.